Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, January 10th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So starting with today's key macro event, leading indicators from Japan and the U.S. continue to support the current Goldilocks top-down market regime. The nuance here is that Japan's topics closed at the highest level since March of 1990 amid a sharp slowdown in wage growth that risks delaying BOJ monetary policy normalization. We do not currently expect the BOJ to tighten at their January 17th or January 18th and our March 10th meetings. The earliest we see them tightening policy is at their April 28th meeting, but we do not see them tightening at all if the momentum in key inflation and wage growth time series remains negative. Yesterday's December NFIB Small Business Optimism Survey supported the soft landing consensus underpinning the current Goldilocks top-down market regime. And then lastly, market implications. The preponderance of evidence continues to signal a rising probability of a soft landing in the U.S. economy. Our positioning model indicates investor positioning is still somewhat stretched, but not to levels that would be consistent with major bull market peaks. The mere fact that there are still investors still parked in the no landing and hard landing camps suggests that there's room to run on the positioning front as they are forced to exit those trades at the margins. Transitioning to my 42 macro dashboard here this morning. For terms of this trading range signals from our friends over at Longbow, we don't have a key macro market indicator overbought, oversold. So we just want to flag where we are in terms of the rate space heading into tomorrow's CPI print and Friday's PPI print here in the U.S. So we're kind of right in the middle of the range on the 10-year, on the 2-year. There's a 2-year nominal treasury yield here. We got downside to about 4.25, upside to about 4.44, and then lastly with the 10-year. Not quite in the middle range, but generally speaking, got about 13 basis points of upside in the range, and you got about 20 basis points of downside there at about 3.80. So we're kind of in the middle range there. So markets aren't really telling you, markets aren't giving you a strong signal that they're expecting one print, a hot print or a dovish print. So it's going to be a little bit of an open envelope risk for today or for tomorrow. And then transitioning to our 42 macro aware community, we're getting a question here on CPI Impact. Says our short-term trade signals. So I'm reading the question verbatim. It's not our short-term trade signals. It's the clients. Says our short-term trade signals indicates that the CPI is unlikely to have an outsized impact on stocks, currencies, or the rate sensitivity complex. Would like to hear what is your lean going into the report and how may it impact pricing and so for futures. So it's pretty interesting. So on the CPI front, the CPI data over the last couple of months have been more hawkish than the PC data, the PC deflator data, which obviously the Fed cares a little bit more about in terms of the PC deflator data. So in our opinion, the Fed pivot, the confirmed Fed pivot that we saw in December, sort of forced the market to sort of elevate the PCE statistics in the kind of broader market discussion and kind of downgrade the CPI statistics at the margins, not materially, but in our opinion, I think we think the disinflation that we continue to observe in the PC deflator statistics is really what's driving the bus in terms of money market pricing, silver futures, et cetera. Just generally speaking, in terms of how to think about heading into these major market catalysts, in our opinion, you have to think about this through the lens and only through the lens of your shorter term risk management signals. And at least at 42 macro, that's our probable range model and our crowding model. And so, what we think in terms of happening in the report is really just what our models are signaling from a very short-term technical perspective. And right now, we're not really getting any strong signal from either our probable range model, nor are we getting a strong signal on any key macro market factor in our crowding model. And so that's telling you that, hey, this is going to obviously go both ways. We're not expecting it to have a material impact, and we certainly don't have expected outcome just based on that signal. For example, if the probable range model said the 10-year yields were overbought or something like that, we'd say there was a high probability of a dovish surprise because the market has already moved in a way that would suggest that you're going to get a hawkish surprise, in so much that, let's say, stocks were on the lows heading into the report, we'd say there was a high probability of a dovish surprise in terms of, in reflating risk asset prices. And so, again, it's really just about the setup, the very short-term tactical setup that's being observed in our models that gives us an indication on what to do from a price standpoint. And as you know, we're not in the business of predicting predictors, so we're going to interpret and analyze the data as it comes out. And I think a lot of investors lost a lot of money in the last, kind of really over the last 3 years, trying to predict every single data point, trying to predict every single wiggle in the market as a function of these data points. And the reality is, if you're doing your job as an investor, you're maximizing upside capture in bull markets, you're minimizing downside capture in bear markets, and you're not wasting too much time, effort, and energy, and ultimately money, kind of trying to chase and trade every wiggle. In our opinion, if you want to chase and trade every wiggle, be my guest. That's just not what we do here at 42 Macro. So with that, we'll wrap it up there. Darius Dale presenting our Macro Minute for Wednesday, January 10th, 2024. We'll be joined by our friend Jim Carson over at Kai Volatility Advisors this afternoon, at noon today, noon Eastern time for our Pro live discussion for this month. So it's going to be a great discussion. Obviously, Jim's a fan favorite amongst our community and amongst the global investor community as well. So very excited for that as well. So we'll catch you back here tomorrow. Have a great day out there.